Do you agree with that relationship in the way that, as Tatiana noted, gold's relationship with stocks has been consistently positive, but there's evidence now that precious metals at the mercy of risk assets and speculation, that those returns could have altered that role of it being a risk asset?
So in the long run, gold has a zero correlation to equities since the 1970s, but it's not stable. It morphs in and out, just about to cause maximum frustration on investors. And the reason why gold has had some headwinds, just like equities, is because in the current environments, nominal yields in bonds have been rising higher, but inflation expectations have not budged, which means real yields have been moving higher. And ultimately, this brick, this barbaric relic, is competing with cash. If you get compensated for holding cash, well, then why hold gold? And the question is really, what's going to persist? One of the unique things about a supply shock is that the economically sound reaction is usually political suicide, and politicians do the opposite of what's the sound thing. Think price controls in the 70s, or help to the consumer during the pandemic. So let this go on long enough. And the government, I'm not trying to be critical of this administration, it happens throughout the world. The Italians just cut the fuel taxes. So the government reaction, that's what gold then reacts to. Or let next week's non-farm payroll report come down and the folks at the Fed say, oh, we got to cut rates, don't worry about this inflation. Miran at the Fed says, oh, we only worry about it if there's a second round effect. So it's that second round that tends to be then supportive of the price of gold.
I get that, but how much is also, Axel, I mean, gold was up, 56% last year, quite a run. Go back the year before, it was up 23%. I mean, so how much is also, though, it just had such a strong run, and some of that had to be undone?
Well, the one thing, there are a whole bunch of different investors in gold. One of the groups that was absent for several years...
Retail?
No, speculators.
Okay.
They were busy with meme stocks, all the wonderful SPACs and crypto. And then a year ago, they decided, hey, gold isn't such a bad place. And so what they do is they mostly increase volatility. And so that's obviously a component that contributes to it. But retail has not had a frenzy. If you look at the total ounces held by the physical gold ETFs, they're not back to the 2022 highs. Of course, nominally we reached new highs, but we haven't had a panic into gold. It's not the typical speculative bubble, so to speak. But what is unique about gold compared to other asset classes, it's a much smaller asset class. And so one of the investors is the quote-unquote gold bug that's worried about fiscal sustainability, while that fringe view is moving a little bit closer to the mainstream. And it doesn't need many of those investors to reallocate to gold for it to have a dramatic run. Now, as we're at these levels, volatility is, of course, very high as well.
So then are you saying there is an opportunity for retail to drive it higher?
Well, of course, the question is the timing, right? I mean, I tell people I'll sell my gold when fiscal sanity comes back to Congress, upon which I get a chuckle and says never, right? And so... But what gold is going to do tomorrow, I don't know. But over the next several years, neither the left nor the right has any intention of doing proper entitlement reform, and neither is their drive to properly drive revenue. And so we are living in eternal deficit.
So you're saying either cut spending or raise taxes, and neither party wants to do that.
That's right.
Or neither party will agree.
Milton Friedman says the only thing you can do is cut spending, because the moment you actually raise revenue, government will find a new way to have yet more spending. And historically, he's right in that. And so going back here to the Iran war, the market is pricing this in as a short-term shock, some differentiation in Europe and here, but even a bad case scenario, let's say the Iranians can charge a gazillion for every ship that goes through, that would mean oil will flow again and we'll live happily ever after. The world is a more expensive place to do business in, and that's historically good for gold.
Go there, because I think one of the things that we keep trying to get to is, what is the longer term impact of this war, this environment where it feels like, you talk about spending, I think about defense spending. We're going to talk about that a lot in our 4 o'clock hour. I mean, we're talking about $1 trillion, budget spending that we're looking for in the United States. Other countries, European, everybody seems to be like focusing on things like defense and spending. And I just think then the fiscal houses of governments get even worse. What are the implications of that longer term?
Well, we live in a different era. The peaceful era since World War II is over. We saw that Ukraine, Gaza, those were symptoms of a new time. Iran is a symptom of this time. Governments are more nationalist. We have protected industries. All of that makes an economy less efficient, there might be the right political reasons to do these things,
Right.
which means will you spending more? You didn't mention climate change, right? All that is making it expensive. Population is aging. Well, we live in democracies. How do you solve these things? You solve them with debt, printing money. And right now, the Fed is quite disciplined, but the interests of government and those of savers are not aligned, and the gold investors is investing based on that.
There are some out there who could be watching right now and say, the administration would probably say this, but the military action that the U.S. has participated in this year, they would say would make the world a safer place. The president has said that many times. And we actually had Wilbur Ross, the former Commerce Secretary, on earlier this week, and he made the argument that essentially the rest of the world has been put on notice that President Trump will use the American military to go after you. Does that make the world more stable?
I'm not doubting that is the right thing to do. Indeed, the Europeans need to get their act together and do substantially more. All I'm saying is less efficient, right? The same with trade. Having free trade makes a more efficient world. It might not be in a national security interest, right? And that's why we put certain blocks in place. And talking about tariffs, it doesn't just impede the flow of goods, it impedes the flow of currency, increasing borrowing costs. So these are things that are happening. I'm not judging, I'm describing. And the gold investor is saying, well, this is a good thing for gold. Now, that doesn't mean gold can't get overheated in the short term or it can't have a very strong correction. But that is one of the reasons why people are investing in gold and continue to invest in gold.
So we're $4,412 an ounce. Do you have a number that you think about how far?
No, you guys always want a number. One of the reasons I don't give a number.
Have you met the Bloomberg?
Yes.
We like numbers.
So one of the reasons I don't give a number is because the market is fairly small. You can get through this number in no time. Right? And so some people have put out a number of 10,000. Says, I'm comfortable with that, right? But I'm not going to put a price target out there because I don't know the horizon, right? Give the horizon long enough, then sure. But it's one of those things that you got to look at the dynamics of the underlying dynamics, and currently, obviously, there's a headwind to price.
Well, we just talked about some of the underlying dynamics that we think is going to be, it's a different world order going forward. Is it fair to say that certainly is supportive of maybe we're at a floor, and that it is supportive for gold to definitely move higher and consistently higher?
Well, we have a new world order every day with a new tweet coming out, with a new statement coming out. What we do know is that the market is pricing this in as a shock and not as something structural. So you can agree or disagree with that, but that's and little difference, a little more long-term implication in Europe than here based on WTI and Brent. If you look at those sort of things, there will be a way to muddle through. If this lasts long enough, there will be substitutions, fracking will increase. We're not going to substitute oil if this thing lasts only a few weeks, but if the market believes it's going to last longer, we will rewire the economy and deal with it in one way or the other.
So shock, we move on.
That's the oversimplified way of looking at it, but that shock can be very painful, of course.
Yeah.
So I'm curious about your view on gold in a portfolio. And everybody's portfolio is different, obviously. But there are those people who are outspoken. Jared Dillian, for example, he says 20% of your portfolio should be in gold, and you should adjust it each year accordingly. There are others who say, okay, throw maybe 5% in your portfolio. Again, different for everybody, but what's your general rule?
Well, you can look at my public disclosures, and I have substantially more in gold mining in particular. I have substantial gold holdings, but I'm not recommending everybody else does that. Investing is about the risk you can afford to take. I happen to think I understand gold. I understand gold miners. Most people don't understand gold. So if you don't understand it, don't pile into it too much. The thing about the gold is it has a volatility about that of the S&P, but that can spike. Now, you've got to be aware of those spikes. Now, anybody who's looked in recent weeks is aware of that, but there are these extended periods where it doesn't. And if you're not aware of those spikes, then you can be caught off guard. And so I encourage anybody to study these things. What is a bad case scenario? Because bad things do happen if you're a longer term investor, and you've got to be comfortable with that. So if you're comfortable with that, I happen to think, yes, a substantial allocation of gold is an important diversifier in a world where bonds might not serve that purpose as much anymore. Obviously, gold is not a direct substitute, but you have the S&P, very tech heavy. If there's a pullback, where do you hide? And gold is but one of the answers to that.
Well, it's an interesting environment where we've spent so many years just talking about, the Mag 7, the big tech names, AI, and so on and so forth. We still talk about it, but it is interesting to see that in terms of investment space, it feels like, commodities, basic materials are something that we've moved into. You are obviously in the precious metal space. When it comes to things like miners, what's your advice to investors in terms of how they look at them? And just got about a minute or so left.
Let me expand on your question. In 2011, Mark Andreessen said software is eating the world. Now software is suffering from AI. Back in 2011, software was low barriers to entry, high margins. AI is high barriers to entry. Who knows what the margins are? If you look at commodities, mining in particular, well, there are high barriers to entry. It's expensive, but the margins are amazing. Even with the pullback we've had, the miners are pricing in that the price of gold would be about 35% lower. And so suddenly we have a somewhat level playing field between tech and mining, and that's one of the reasons why I think more investors will pay attention to it.